Welcome to the Salmon Runs YouTube. Enjoy the video.
In this video, I will explain how to use a ledger and journal. A journal serves as the initial record for all your business transactions. Think of it as a diary where every financial event is noted down in the order it happens. This chronological record includes the date, the specific accounts involved, and the corresponding debit and credit amounts. It's the first step in tracking your company's financial story. After recording transactions in the journal, the next step is to transfer them to the ledger. The ledger organizes all your financial data by individual accounts, like cash, accounts receivable, or expenses. This gives you a clear, summarized view of each account's activity and its current balance. Often, a T account format is used, with debits on the left side and credits on the right, making it easy to see the flow of funds. To journalize a transaction, first identify the accounts involved and how they are impacted, whether increasing or decreasing. Then, apply the rules of debit and credit. For example, an increase in assets is a debit, while an increase in liabilities is a credit. Finally, record the date, the debited account and amount, followed by the credited account and amount, ensuring total debits equal total credits. Once transactions are journalized, the next crucial step is posting them to the ledger. This involves transferring each debit and credit from the journal to its respective account in the ledger. After all entries are posted, you'll calculate the ending balance for each ledger account. This process helps ensure accuracy and prepares your accounts for financial statements. Remember to check the description for links to great deals, including Little Tree's black ice to keep your car smelling fresh.
Thanks for watching. Consider subscribing if we helped you.